To succeed in investing throughout your life doesn't demand sky-high IQs, extraordinary business acumen, or insider information. Are you investing, or are you playing a game whose rules you don't fully comprehend? Amidst countless flashing tickers, overwhelming recommendations in reports, and language so dangerously certain, how can an individual without a team behind them, without cutting-edge technology, survive and thrive in a financial market that operates like an emotionless yet instinct-driven machine? Is there a foundational principle that endures through time, capable of standing firm through every up and down cycle, every political storm, and every wave of technology, not to make you the best, but to ensure you remain after those seemingly smarter have been swept away? If that question makes you pause to think, then you're holding the right book. And perhaps it's time to reread the concept of survival not as a passive state, but as an active art of living in a land where losses strike without warning and mistakes offer no second chances. We will start from the foundation. No promises of success, only to understand clearly how not to be erased by the market before you've learned to write your own investment story. Now, let's begin this summary of the book with me. People often think investing is a game of numbers, a series of formulas written by brilliant minds, and all you need to do is memorize them to win. I used to believe that until I personally threw thousands of dollars into the market and watched them vanish into thin air in a single trading session. That wasn't a game. That was a war with no ceasefire, no place for the unprepared. In that war, no one can protect you but yourself. You can't rely on your broker. You certainly can't count on the market to recover exactly when you expect it to. What I learned after decades is that survival in investing doesn't come from buying good stocks, but from knowing how not to die from bad ones. I remember the first day I stepped onto Wall Street. It felt like an unarmed person walking into a casino, eyes full of confidence and pockets empty of experience. The books I read taught me all sorts of theories, but not a single page told me what it felt like to lose everything. Not a single chart pointed out where greed becomes blind and fear becomes the guide. That's when I understood. The market doesn't reward the diligent, it only rewards those who are right. And the cost of being wrong is very high. Sometimes it's your entire life savings. You might be a brilliant analyst, you might have a PhD in finance, but if you don't understand how the market reacts, you're just prey waiting to be devoured. Many people ask me, what's the difference between investing and speculating? I don't answer them immediately because that question is like asking a doctor how treating a disease differs from emergency surgery. In theory, there are hundreds of differences. But in reality, when a patient lies motionless on the operating table, you have only one job: keep them alive. It's the same with the market. You buy a stock because you think it will go up, that's speculation. You hold a stock because you believe in its long-term value, that's investing. But no matter what it is, you're making a bet. The problem isn't the name, the problem is knowing what you're doing and why. I used to invest like a dreamer. I believed there would be perfect investments, safe stocks, stable returns, sustainable growth. But then I saw the truth: every choice is a potential trap. Good stocks can be hated by the market. Bad stocks can skyrocket just because of a rumor. The investment world has no justice, it only has probabilities. Newcomers are always the easiest prey. They enter with bright eyes, believing that by simply following what successful people have done, they'll achieve similar results. But they don't know that successful people have survived hundreds of battles. They've learned how to dodge, how to retreat, how to mislead. Newcomers don't. They buy at the peak, sell at the bottom, and when they lose money, they think the market is a scam. But no, the market doesn't scam anyone. It just has no mercy for fools. I once met an old friend who was a doctor. He had just retired and decided to use his savings to invest in stocks. He told me, "I don't need much profit, just preserving the value is enough." I stayed silent because I knew that when you invest only to preserve money, you'll have no reason to exit a losing investment. You won't dare to sell when you need to. And so, you slowly die in the belief that you are safe. There is no safety when you don't have clear goals. I learned that every time you place a buy order, it's a commitment. And if you don't know why you're buying, you won't know when to sell. I started setting principles. Before buying a stock, I had to write down the reason, the goal, and the maximum loss I could tolerate. If any of those three things changed, I would sell without regret, without explanation, without blaming the market. Many people confuse knowledge with intuition. They think the more books they read, the more tools they learn, the more successful they'll be. But I tell you, if you don't have intuition, you'll never survive. The market is a game of reflexes, not dogma. People often misunderstand the market because they approach it as if it were an orderly, ethical entity that can be predicted by logic. But the market isn't like a teacher, it's like a fickle child. Today it loves you, tomorrow it spurns you for no reason. You can study all the indicators, financial reports, charts, models, and still be caught off guard by a sudden shakeup no one predicted. I've met very intelligent, wealthy, and well-positioned people who were mercilessly crushed by the market because they brought the most dangerous thing into it, their ego. They thought because they were good in other fields, they would also be good at investing. They applied rules for success from business, from medicine, from law, to a place where no rules stand still. They didn't understand that the market is where everything can be right and wrong at the same time. The first time I saw a stock plummet sharply, even though the company had just announced good profits, I was very confused. But then I understood. The market doesn't operate on reason, it operates on expectation. And expectation isn't something you can measure with data. Sometimes good results are a signal to sell because people think that's the peak. Sometimes bad results are a buying opportunity because someone expects a miracle to happen. That's why I learned to look deeply into cash flow. A financial report is a picture, but cash flow is the bloodstream. You can paint profits, but you can't fake cash flowing into an account. I always ask, where do the profits come from? Core business operations, or asset sales, clever accounting, or a magic trick from one expense to another benefit? I never buy a stock just because it seems cheap. A low price doesn't equate to value. A stock can drop 90% and still fall another 90%. Conversely, a rising stock is sometimes a safer place because at least the market is supporting it. Price doesn't reflect reality, but it reflects sentiment, and in the short term, sentiment is what kills you. When I was young, I believed that simply choosing the right stock was enough. I focused on selection, on finding the gem in the rough. But later I realized, more important than what you choose is how you handle it when it doesn't go according to plan. Do you dare to cut losses? Do you dare to take profits? Do you have enough discipline to do the right thing when everyone else is doing the wrong thing? I once held a falling stock simply because I didn't want to lose money. Sound familiar? That's the most common trap. We hate losing money so much that we accept losing more, just hoping for a vague recovery. I held that stock for 6 months, watching it drop day by day like a prolonged fever. By the time I sold, I had lost 80%. And the most painful thing wasn't the money, but the fact that I knew I was wrong but I didn't act. After that, I set a fixed loss limit of 10%. If the stock dropped beyond that, regardless of the reason, I sold, no questions asked, no further analysis, no hope. Because I understood that a small hole you don't mend in time will become a large tear that shreds your portfolio, and no stock is worth destroying your principles for. Some people think they'll succeed by going against the crowd. They hear advice like, be greedy when others are fearful. But they forget that to go against the crowd, you must understand what the crowd is thinking and why. Going against the tide without understanding its flow is a suicidal act. I only buy against the current when I see a clear discrepancy between reality and expectation. If you're simply buying because everyone else is selling, you're gambling, not investing. The market doesn't need you to be right. It doesn't care about your reasoning. You can be right 10 times and wrong once, but if that one time you bet everything, you still lose it all. I learned to allocate capital as if I could always be wrong. I never put all my eggs in one basket. Each investment occupies only a small portion of my total capital. If it fails, I still survive. And in investing, survival is a form of victory. I don't believe advice from the media, from TV experts, or from friends because they don't bear the consequences for me. I only listen to myself after I've analyzed, questioned, and am ready to accept the outcome. You must take responsibility for your own money. No one cares about your investment portfolio more than you do. Remember that. I also don't believe in holding forever. Everything changes. The company you love today can turn into a disaster tomorrow. Technology changes, laws change, people change. If you don't update your perspective, you'll be the last one to leave the party. I always ask, what has changed since I last checked? Is my investment thesis still valid? If not, I act, and I am never bound by the past. One thing very few people are willing to accept: the market doesn't need you to stay. It never opens its doors to welcome you back after failures. The market is a place where the survivor is someone who knows how to retreat, sometimes even faster than when they entered the trade. What is called patience only makes sense if it's applied to the right circumstances. If you're patiently holding a dying stock, you're complicit in your own financial demise. I set a rule for myself: never fall into the trap of what the price used to be. When you think a stock was once $100 and now it's only $40, so you should buy, you're deceiving yourself. The market has no memory. It doesn't care about the past, only you do. And that makes you dangerous to yourself. I only look forward. Can it still create value, not how it was once valued? Many people also mistakenly believe that if a business performs well, its stock price must rise. But the market is not an honest scorecard. There are companies whose profits steadily increase, but their stocks remain stagnant. Conversely, there are companies with cumulative losses whose stocks skyrocket just because of a rumor or a compelling story. I used to believe in fairness until I lost money by putting my trust in financial reports more than in what the price was telling me. When you've been in the market long enough, you'll see a paradox. The more information you have, the easier it is to be deceived. The truth isn't in the quantity of news you consume, but in your ability to classify, filter, and discard what's unnecessary. I used to read 50 pages of news every day, review every report, analyze everything, yet still lost money. It wasn't until I learned to ask 3 clear questions: why buy, where to buy, when to sell, that everything became clear. Investing is not a job for those who seek absolute safety. If you're looking for a place where you can place your trust, you should go to a bank. But if you're in the market, you must accept that fear is an integral part of the journey. I've been afraid many times, but I don't let fear dictate my behavior. I use it to reevaluate my assumptions. If I still find my logic sound, I hold. If not, I retreat. I don't highly regard those who always talk about long-term plans without a short-term strategy. You can say you'll hold a stock for 10 years, but are you sure you'll survive after 3 months of a 30% decline? Are you sure you won't sell in panic during an unexpected crisis? I always plan step by step. If the market goes up, what do I do? If it goes down, what do I do? Not to predict, but to prepare. One of the things I learned is to stay away from investment truisms repeated too many times, like buy and hold always wins. That statement might be true in some phases, but if you buy and hold a bad stock, you're holding risk, not value. I once held a stock that people called a growth superstar. I held it for 2 years, watching it plunge from its peak to rock bottom. In the end, I wasn't holding a stock anymore, but a costly lesson. If you ask me what's most important for survival in the market, it's not strategy, it's not tools, but attitude. The attitude to accept that you can be wrong, the attitude to be willing to learn from scratch, the attitude to let go of ego and never consider yourself special. The market doesn't reward arrogance. It only keeps those humble enough to listen to its signals without being enchanted by their own echo. And finally, I learned that every investment decision must be built on observation, not blind faith. I no longer believe in potential, sectors, or historical cycles mechanically. I observe cash flow. I track the behavior of large investors. I pay attention to timing because even very good stocks can kill you if you enter at the wrong time. You've seen it already. Survival in the market isn't about the smartest people, it's about the most sober people. And being sober in this context means never believing you're immune to mistakes. During my process of learning to survive amidst the fierce waves of Wall Street, there's one thing I always remembered. Financial reports can be a place to hide the truth. The numbers on paper are sometimes presented to please investors, not to tell the actual story of the business. If you completely trust what's printed, you're playing a chess game where pawns are painted as queens. I have seen companies report growing profits year after year, but in reality, it was just transferring money between accounts, deferring expenses, or boosting revenue with creative methods. I'm not saying everything is fake. I'm just saying you must be suspicious. Learn to ask questions. If a business grows steadily with good profits, but its stock doesn't rise, why? If a business has an unusually high level of debt, is it hiding a risk? If the management continuously sells shares, do they still believe in the company's future? I learned to read reports like a detective reading a crime scene, not to hear a story, but to find the holes in the story. Many people think investing is a technical matter, picking good stocks at the right time, managing a portfolio logically. True, but not enough. The other part, even more significant, is psychological. I've witnessed people with perfect strategies fail simply because they couldn't withstand the pressure when a stock price fell. They looked at their accounts every day, every hour. They panicked when the market turned red. They held onto profits until they became losses, and then they gave up. I don't blame them. I'm just saying that if you don't train your psychology, you won't last. There was a time when I nearly lost everything. My portfolio dropped by almost half in just a few weeks. I panicked, I despaired. I started seeking advice from experts, hoping someone would reassure me. But then I realized no one could make decisions for me. I had to face it myself. And when I looked back at what I had done, I clearly saw that the mistake wasn't in the stock, but in me. I was too confident. I ignored warning signs. I thought I knew it all. The biggest mistake investors make isn't a lack of knowledge, but thinking they know enough. After that incident, I completely changed my approach. I built my investment portfolio like a fortress. Each position had a specific function, each investment had clear goals and timelines. I no longer let emotions dictate buying and selling. Instead, I plan like an engineer building a bridge, step by step, layer by layer, with clear loss limits. I knew I couldn't avoid risk entirely, but I could prevent it from killing me. One of the most important rules I set for myself is never to chase a losing investment. If a stock falls, I don't average down. I don't buy more just because I think the price is now so attractive. I used to do that, and I used to die. So I understood that if I was wrong, pouring more money into it would only make me more wrong. And if I was right, I'd have a chance to return later at a more favorable risk level. Many people refuse to sell at a loss because of their ego. They don't want to admit mistakes. They hold stocks as if holding their pride, but the market doesn't care about your ego. It only cares whether you have enough capital to keep playing. I once sold at a loss just to preserve my account, and later, I was always grateful for that decision. You might be criticized for lacking patience, but I'd rather be criticized than have my account blown up. Later, I realized something strange. Sometimes the best investment is the one I didn't make. Because I knew if I rushed in, I would lose my discipline. I would become greedy, and once greedy, I would be blind. I once sat watching a stock rise without entering an order, simply because I didn't see enough logical reasons to participate. Then the price collapsed. I wasn't happy that I escaped. I was just relieved that I had maintained my principles. Investing isn't about how many times you're right, but about earning enough when you are right and losing very little when you are wrong. I never enter a trade with an all-in mindset. Each investment occupies only a small portion of the total capital. That way, even if I'm wrong, I still have the strength to continue. The mistake many people make is betting big on what they are certain of. But in the market, nothing is certain except uncertainty. The more I experience, the more I believe that investing is a battle for survival, not a wisdom competition. You don't need to know the most, you just need to know the right thing at the right time. You don't need to catch the bottom or the top, you just need to maintain your position when the trend is clear. And most importantly, you don't need to win every time. You just need to survive long enough to win when it matters. I used to think that just picking the right stock would make everything smooth. But then I learned a bitter lesson. There are no absolutely good or bad stocks, only stocks that are suitable or unsuitable for your situation. A stock that rises 300% in one person's hands might fall 50% in another's, simply because of different entry times, different expectations, or different risk tolerance. And that led me to a deeper realization. Investing isn't just about the assets you buy, but about you, the buyer. You are the unquantifiable factor. If you are psychologically weak, lack a plan, or are too rushed, you will turn every investment into a ticking time bomb. But if you are steady, clear-headed, and disciplined, even mediocre stocks can yield profits when handled correctly. Many people enter the market with the illusion that they will get rich quickly. They think this is a place where money makes money with just a few clicks. I have seen them. They buy stocks because of a social media post, a whispered tip from a friend, or because everyone else is buying. Then they dream of getting rich, but the market doesn't create millionaires. It just transfers money from the impatient to the more patient. I learned that the market doesn't reward correct behavior. It only rewards correct behavior at the correct time. That means you can analyze every factor correctly, but if you enter too early or too late, you still lose. Therefore, I no longer heavily weigh being right in analysis. I learned to observe cash flow, listen to signals from the market, and only enter when there is confirmation. You don't have to be the first, you just have to not be the last. For a time, I was absorbed in finding the optimal method. I read hundreds of books, experimented with all sorts of technical indicators, valuation models, and trading strategies. But then I realized there was no holy grail. What worked today might be useless tomorrow. The market doesn't follow a formula. It's a living, constantly evolving organism, and you can only survive if you're flexible. So what did I do? I started simplifying everything. I focused on principles instead of models. Principles like, don't chase the market when it has run too far, don't buy a falling stock without signs of a bottom, don't hold a stock whose management doesn't own shares, don't ignore trading volume because big money always leaves a trace, and above all, always set a stop-loss order. Stop-loss sounds simple, but executing it is an internal battle. You have to overcome the fear that it will rebound after you sell. You have to accept a small loss to avoid a big one. I used to delay stop-loss just because of hope, and that very hope killed me. Now I consider stop-loss my best friend. It doesn't betray me, only I betray it. Another thing I always share with young people new to investing: learn to observe others but don't imitate them. I once lost money just by imitating the portfolio of a famous investor. He bought a stock and it went up. I jumped in, thinking I was on the side of the wise. Then he sold, but I didn't know. And when the price dropped, I was stuck. Lesson: you never know what others are thinking, so it's best to act only on what you truly understand. I also learned to observe myself. I recorded my emotions during trading, moments of excitement, panic, overconfidence. I recognized emotional patterns within myself, and once I understood them, I started setting up preventative mechanisms. For example, if I found myself too euphoric after a string of winning trades, I would stop for a few days. Because I knew euphoria is a prelude to complacency, and complacency is the fire that burns down a portfolio. Investing is my own affair. But later I realized investing also concerns family, the people you love. Every decision you make can affect their lives. So, don't let greed lead you. Let responsibility and clear-headedness be your companions. I always remind myself that every dollar I put into the market is part of the future I'm building for others, not just for myself. And because of that, I always consider, is this investment worthwhile? Is the risk controlled? Am I willing to pay the price if I'm wrong? If I can answer yes to all three, I enter the trade. If not, I stay out because I've learned that staying out of the market is also a form of investment. An investment in safety, in observation time, in the ability to return stronger. In the end, after all the falls, the sleepless nights, the moments of self-doubt amidst crises, I came to a hard-to-swallow conclusion. No one can protect you from the market but yourself. No tool is absolute, no system is invincible, and certainly no expert can live for you when your account is in the red. It's a lonely journey, but it's a necessary kind of loneliness for you to listen to yourself. If you've never experienced sitting in front of a screen, watching a stock in freefall, unable to do anything, then you haven't truly understood the market. That feeling is like witnessing a house on fire when you only have a glass of water in your hand. You can panic, you can freeze, or you can learn not to build your house with straw anymore. I learned that losses are inevitable, but repeating the same mistake is a choice. I once held a stock I loved. The company had a good story, strong management, great market potential. But then the financial reports showed unusual signs. I found every reason to defend it. I thought it was just temporary, that the market was overreacting. I held and the stock continued to fall. I thought, this is an opportunity to buy more, average down. Then it kept falling. And when I sold, I didn't just lose money. I lost faith in my intuition. Not because I was wrong, but because I didn't dare to admit I was wrong early on. And so I established a vital principle. Every decision must have a clear reason, and that reason must be verifiable with data. Emotions are not allowed to interfere. A stock is not your family. You don't need to be loyal to it. You only need to be loyal to your principles. When you make money, it's not because you are brilliant, it's because the market allows you to win. And when the market changes its mind, it takes everything back, not leaving a penny. The successful investors I know all have something in common. They are strangely humble. They never boast about profits. They are not overly confident because they know tomorrow the market might teach the old lesson in a new way. If you ask me the secret to surviving and investing, I won't talk about stocks. I'll talk about habits. The habit of writing down reasons for buying and selling. The habit of rechecking assumptions every week. The habit of reading the ticker not to get excited, but to monitor for unusual signs. And most importantly, the habit of getting back up every time you're knocked down. I once met a person who invested only by feeling. He was very sensitive and at one point made huge profits. But then, one time he was wrong, he didn't cut his losses because he believed his intuition couldn't be wrong, and he lost everything. I learned that intuition is very important, but it must be built on a foundation of data. If you only invest with emotion, you're playing a game of chance with your life. I have never considered the market a place to get rich quickly. For me, it's a place to cultivate clear-headedness, discipline, and courage. There were years when I didn't earn anything, even incurred slight losses. But I stayed because I understood that by surviving long enough in this game, you'll have opportunities for big wins if you're still alive when those opportunities arise. And to survive, you must learn to ask questions continuously. Questions not for others, but for yourself. Am I holding this investment for a logical reason, or just because I don't want to admit I'm wrong? Am I ignoring risks because I'm too confident in an optimistic scenario? Am I trading out of boredom instead of a genuine opportunity? When you learn to ask those questions and answer them honestly, you are moving closer to the realm of professional investors. To conclude the first part of this journey, I'm not offering a set of formulas or a magical system. I'm just recounting what I've lived through. The times the market crushed me, the resurrections in pain, and the small but meaningful moments when I felt that this time, I got it right. If you've listened to me tell this far, perhaps you are also on that journey. A journey where no one applauds, there are no medals, no cheering, only a simple truth. You are still here, and in the world of investing, sometimes that alone is a victory. I don't know if you've ever experienced that feeling. The feeling of watching the ticker, your heart pounding wildly as a stock plunges like an out-of-control roller coaster. You tell yourself, it'll surely recover, and you wait. And when it drops another 10%, you tell yourself again, well, I've already lost money, might as well hold. By the time it drops 30%, you don't even have emotions anymore. You close the screen, go for coffee, and whisper to yourself that you're a long-term investor. I've lived through such moments, and I understand that most losses don't come from the market, but from the human psychology of not accepting being wrong. We are not born to invest. Our survival instinct makes us fearful when we see red prices and euphoric when we see green prices. But the market demands that we do the opposite. Sell when people are greedy and buy when everyone is fleeing. To do that, you need an ability akin to meditation, to detach yourself from the emotional currents of the crowd and listen to the cold logic of numbers. I once analyzed a stock that everyone was rushing to buy. The company had good growth. The financial reports were like a dream. Management appeared frequently on TV, speaking in promising tones, but I felt something was off. The profit margin was too thin compared to the industry, debt was increasing rapidly, and notably, the amount of treasury stock the company was buying back was unusually high, a sign that they were trying to prop up the price. I didn't buy. 2 months later, a financial scandal broke out, the stock went into freefall, and I learned another thing. The market always shows signs, it's just whether you're willing to see them. You could call it intuition, but in reality, it's the result of observing enough, thinking long enough, and being willing to ask difficult questions. Why is management selling shares when the price is rising? Why don't they specifically explain the sudden increase in accounts receivable? Why are dividends paid in shares instead of cash? Each question is a step closer to the truth, and the truth in investing is the most valuable thing. I never blindly believed in technical analysis, but I didn't ignore it either. I saw it as a kind of emotional map, where I could see if the crowd was euphoric or panicked. A long candlestick on a chart wasn't a buy or sell signal, but a whisper. Something has happened, pay attention. I didn't buy on a breakout or sell on a death cross. I only used technical analysis as a tool, not a guiding principle. And I always paid attention to timing, not because I thought I could catch the bottom, but because I understood that there are periods when you should stay out. The market has seasons, just as farmers know when to sow and when to reap. Investors must also learn when to stay and when to retreat. I once stayed out of the market for 3 months, not making a single trade. Everyone asked, "What are you doing?" I just smiled because I knew doing nothing was also doing something. If you're waiting for the right moment, that moment often comes with quietness, when people have forgotten a stock, when there are no more analytical articles, when liquidity dries up and everyone is fed up. That's when I start to pay attention, because opportunity doesn't come when the spotlight is shining. It comes in the dark corners, where only the patient can see it. I also learned to read the news with a skeptic's eye. An announcement of increased profits didn't make me rejoice. I asked, from what source did it increase? A plan to expand into new markets didn't excite me. I asked, where is the money coming from? A grand acquisition didn't fill me with admiration. I asked, does it truly create value? Because most things that boost a stock in the short term aren't sustainable. It's media effect, expectation, dreaming. But you can't live on dreams. You need real profits, real cash flow, so I focus on that. Businesses with stable cash flow from operations, low debt, transparent governance, those I consider. For everything else, no matter how attractive the story, I stay out. And even when I enter in stages. Never commit all capital to one order. I buy a small amount first, like a probe. If everything is fine, I increase my position. If it's wrong, I cut immediately without hesitation. Because in this market, the truth comes very quickly. It's just that we are unwilling to believe it. The most dangerous thing in investing is not a lack of information. No, the most dangerous thing is having too much information and believing it indiscriminately. I once sat in front of the screen with 3 different analyses of the same stock. One said to buy immediately because technical indicators signaled a rise. Another advised waiting because the trend wasn't clear. And one warned of a deep decline due to macro risks. All 3 articles were logical, with sharp arguments. And if you don't have an internal frame of reference, you'll be dragged into a vortex of confusion, eventually standing still, daring to do nothing. The market is not a place for perfectionists. You will never have complete data. You will always have to make decisions in opaque conditions where every indicator is just a sign, not the truth. I learned to accept uncertainty. I don't try to find guarantees. I just need to know if the risk is within my control. If it is, I step in. If not, I wait. And more importantly, I never make a decision based on just one reason. I need at least 3 reasons to buy a stock. If there's only one, no matter how strong, I don't do it. Because one reason can be an illusion, but if 3 independent signals point in the same direction, that's usually a more reliable sign. Like when technical analysis, cash flow, and news all indicate something is happening. I will scrutinize it, but only if I have an exit plan. You'd be surprised how many people enter the market without ever thinking about a way out. They place buy orders but have no selling points. They expect prices to rise but don't set stop-loss levels. I used to be like that. I thought, just buy first, then figure it out. And I paid the price with losses that lasted months, eroding my confidence and making me afraid to even open the trading screen. I started writing everything down before trading. Why am I buying? What is the price target? Where do I cut if the price falls? And what do I expect within what time frame? If things don't go as I predict afterward, that's okay. I just need to go back to my notes, see where I was wrong, and learn from it. But if I have nothing to refer to, mistakes will just keep repeating, because human memory is very good at rationalizing itself. For a time, I was fascinated by hot stocks, the ones mentioned daily in the news, hotly debated in forums with surging liquidity. I thought, it can't be wrong. Everyone is getting in. And then I found myself being the one buying at the peak, while those who got in earlier had quietly exited. After a few such instances, I learned a valuable lesson. The crowd never gives you the best position. If you hear noise, you're already late. And so, I started paying attention to stocks less talked about, businesses with simple models, stable cash flow, overlooked by the market because they weren't sexy. I didn't need glamour, I needed sustainability. I carefully read overlooked items like selling expenses, cash flow from investing activities, the rate of increase in charter capital. Because there, I often found real indicators while everyone else only looked at EPS or PE. The market, in essence, is a rotation mechanism between expectation and reality. When expectation is too high, even if reality is good, the price still falls. When expectation is low, a small signal can create a wave. I learned to observe not just the business, but the market's sentiment towards that business. Sometimes the company doesn't change, but the market's perception changes, and that's when opportunity arises. But opportunity only matters if you still have capital, and capital isn't just money, it's also resilience, patience, and a calm mindset. I once entered a beautiful trade, aligned with the trend, and the stock surged. But because I was exhausted from previous losses, I cut too early, and I missed an entire growth cycle simply because I no longer believed in myself. That's when I understood. Not just the account needs protection, but also the psychology. You can't be a good investor if you carry panic, fear, or repressed greed. The market will sense that, and it will make you pay. I started meditating, not the cross-legged, chanting kind. I meditated by sitting still for 15 minutes before trading, breathing deeply and writing down every emotion I was feeling. If I was scared, I didn't trade. If I was euphoric, I also didn't trade. I only traded when I felt normal. I was once taught that the market is where supply and demand meet to determine price. It sounds scientific, but in reality, price is sometimes created by something immeasurable, the emotions of a group of people capable of stirring up a wave. These people don't appear in newspapers, don't comment on forums, and don't write analytical articles. They only leave faint traces, an unusual buy order, a sudden surge in trading volume, a perfectly timed news leak. I call them the people behind the curtain, and you need to learn to see through that curtain. I once noticed a mid-cap stock that had been languishing for months, almost unnoticed. Then suddenly, its trading volume doubled for 3 consecutive sessions with no special news. I didn't rush in, I observed. By the second week, a few newspapers began writing articles evaluating the growth potential of this stock. That's when I knew the game was set. The people behind it had finished accumulating shares, and now it was time to inflate the price with expectations. I didn't fight them. I went along, but always kept my hand on the trigger. You can't win in a game whose rules you don't understand. And on Wall Street, the rules aren't written down. They lie in repetitive behaviors. I learned to record trading patterns, how cash flow shifts from one sector to another, how news is leaked in a sophisticated cycle. And I gradually realized that investing isn't an exact science, it's an art. And like all art, you have to feel the rhythm. But feeling doesn't mean guessing blindly. I always have an action plan. When a stock starts to rise sharply, I don't dream of colossal numbers. I set a profit target, and if reached, I sell a portion. Not because I'm certain the peak has arrived, but because I want to secure some of the gains to maintain a stable mindset. If the price continues to rise, I hold the rest. If it reverses, I've already made a profit. Winning in the market isn't about being absolutely right, it's about not losing heavily. And in many cases, the best action is to do nothing at all. I once stayed out of the market for 4 months. Not a single trade, not a single stock met my criteria. You might call that an opportunity cost. I call that preparation. Because when the wave came, I had cash, I had the mental fortitude, I had discipline that hadn't been eroded by meaningless swings. And I entered at the right moment. In the next 2 months, I earned enough profit to make up for the entire year. Not because I was better than anyone, but because I knew how to wait. Waiting is a skill few people talk about. People talk a lot about stock picking, technical analysis, reading financial reports. But waiting when the market trend is unclear, waiting when cash flow hasn't confirmed, waiting when sentiment is still chaotic, that's what distinguishes survivors from those who are eliminated. I once entered a trade just because I hadn't traded for too long. I felt my hands itching, and then I lost. Not because of faulty analysis, but because I traded to satisfy a feeling, not a real opportunity. Emotion is a silent destroyer. You think you're analyzing, but in reality, you're trying to prove yourself right. You think you're waiting for confirmation signals, but in reality, you're hoping the market will follow what you believe. I learned to detach myself from investments. I don't favor any stock. I don't love any company. I just observe, make decisions, and am willing to let go if necessary, like a chess player who doesn't regret sacrificing a rook for a better position. I also learned to question myself every time I wanted to buy. Am I trying to invest or just trying not to miss out? Too many people get caught in the FOMO spiral fear of missing out. They see a stock rising and think if they don't get in now, they'll miss the opportunity. They don't ask themselves if they understand this business, if the cash flow is real or just a pump and dump scheme. They don't care. They just want the feeling of being in, and they are always the ones buying at the last price zone before everything reverses. Conversely, I learned to accept standing aside when everyone else is making money. I don't envy, I don't compare. I just focus on my system, and if the system doesn't give a signal, I do nothing. I accept being called out for missing out, rather than getting stuck in a downturn I wasn't prepared for. There are times when the market seems predictable. Everything is ideal. Good reports, strong cash flow, positive news. And then a sudden event, political, legal, natural disaster collapses everything in a few sessions. At that point, only those who prepared for the worst-case scenario survive. I always have a plan for situations where I'm wrong. I always ask myself, if the market reverses tomorrow, what will I do? If I don't have a clear answer, I don't enter the trade. And I believe that the ability to envision the worst-case scenario and accept it is the core of investing. I'm neither optimistic nor pessimistic. I just want to know if everything goes wrong, will I still be okay? And if I can genuinely say, still okay, I act. People often say, let profits run and cut losses quickly. It sounds simple, but practicing it is an extremely difficult psychological challenge. I once held a stock that rose over 40% in just a few weeks. Everything was favorable, strong cash flow, positive news. But in my head, a question kept echoing. Sell now to take profits or continue holding because it might go up further? I held, and 3 sessions later, the stock reversed into freefall. I still held, hoping it was just a correction. Another week passed, and the 40% profit became 15%. By the time I sold, I regretted it and was angry with myself, and that lesson stuck deep. Nothing is certain to keep rising. The market can take everything back in a single gust of wind, not because the business got worse, but because investors changed their expectations. They worry, they take profits, they react to a signal you never anticipated. Therefore, I learn not to be greedy when I'm winning. I scale out of positions, selling in predetermined tranches. I always keep a small portion if the trend is still good to remain involved, but I never leave all my profits in the hands of the market. And time, I realized, is the most undervalued factor. Most newcomers only think about the entry point, not the length of a cycle. They imagine stocks will rise forever or fall forever, but no, every wave has an end. There are stocks that increased 200% in 3 months and then traded sideways for 2 years. If you don't have a strategy, you'll get stuck in dead spots where capital is locked up, expectations are frozen, and your psychology wears down daily. I once held a stock for 9 months that didn't go up, didn't go down, just flatlined around one price. I waited. Each month that passed, I told myself, it must be almost time. But it wasn't, and then I looked back. If I had used that money to invest in another opportunity, I probably would have made 20% or more. Instead, I let the capital sit dead. I learned that not only losses are costly. Losing time is also a type of investment cost. And the most painful thing was that when that stock finally started to rise again, I no longer had the patience. I was tired. I had sold out for a small profit, then watched it soar 50% in the next 2 weeks. A devastating blow to my morale. If you haven't experienced that feeling, you haven't invested long enough. And if you have, you understand. Psychological exhaustion can make you destroy what you've built. That's why I started measuring not just profit, but mental energy. Every stock I hold must be psychologically monitored. If I find myself waking up every morning just to check prices, if I feel my heart race every time it fluctuates, if I find myself unable to analyze objectively, I sell. Because clearly, I am no longer an investor. I am a hostage to my emotions. Someone asked me, "Why do you sell stocks?" I replied, "when the reason to hold it no longer exists." And that reason isn't just with the business, but also with me. If I'm no longer clear-headed, if my expectations were wrong, if I'm rationalizing more than analyzing, I exit. Not because I'm pessimistic, but because I want to preserve myself for the next opportunity. Because in this market, opportunities are not scarce. What's scarce is capital and clear-headedness. I don't regret a missed opportunity if it helps me maintain a better position. I don't try to recover losses after a downturn because I know the more I try to recover, the more likely I am to lose both capital and reason. I learn to rest. I learn to disconnect after a stressful trading streak. I take walks, read books, sit and watch trees not to escape, but to recharge my energy. Investing isn't a sprint, it's a marathon. And if you burn yourself out in the first 5 kilometers, you'll collapse midway. I've witnessed many people win big in a bull cycle, then lose everything because they didn't adapt when the market reversed. They didn't lose because of a bad strategy. They lost because they were overconfident in the old cycle. I ask myself every month, am I trading based on old habits in a new market? And if I am, I immediately stop. I learn to wipe the tactical board clean and redraw it from scratch whenever the context changes, because the context always changes. Only you don't realize it when you're still intoxicated by victory. There's a word I always emphasize to anyone entering the market: defense. Most people only focus on offense, picking stocks, finding entry points, predicting rising waves. But they forget that survival is more important than winning. You can win 10 times, but if one loss wipes out everything, you're no longer an investor. You're just someone lucky whose luck ran out. Defense, for me, starts with doing nothing. I don't jump into every opportunity. I don't enter the market just out of fear of missing out. I observe, and I only enter when I clearly see that I can control the risk. Control here doesn't mean eliminating risk, but knowing exactly what you're facing, what the worst possible loss is, and if it happens, you will still survive. I don't like using leverage. Many people ask me why, because using margin helps amplify profits. I just smile. Margin also amplifies mistakes, and when mistakes happen, you no longer have time to correct them. You're forced to sell, not because you want to, but because the system makes you. I want to keep the power of decision in my hands, and to do that, I always keep my risk level where I can be proactive. A strategy I very often apply: take some profit, hold some. When a stock reaches my initial expected target, I don't dream it will double again. I take some profit to ensure I've made money. The rest I let run with the trend. If it continues to rise, I benefit more. If it turns around, I've secured some of my gains. This helps me maintain a balance between ambition and clear-headedness. Once, a stock I bought increased by 50% in just 3 weeks. I took 50% profit at my target level and held the rest. 2 weeks later, it dropped 30%. I sold the remaining portion, and overall, I made a profit. But the most important thing was that I didn't regret it because I had acted according to my plan. And it's the plan that lets me sleep peacefully at night, not the profit figures. Defense also involves holding cash. Many people hate the feeling of leaving money idle. They see a large balance in their account and feel it's a waste. I'm different. I see cash as reserve ammunition. I'm not afraid of a market crash. I'm only afraid of not having bullets when opportunities appear. Cash gives me flexibility, and flexibility in an uncertain market is the strongest competitive advantage. Once, after a deep market downturn, many good stocks were mercilessly sold off. Those who were fully leveraged couldn't do anything, they were forced to sell. But I, with readily available cash, selectively entered positions cautiously. 6 months later, my portfolio recovered strongly, not thanks to any brilliance, but because I was still alive and had capital when others had given up. I'm also careful with dead corners in my portfolio. Sometimes you don't realize you're holding stocks that no longer have any potential but you don't sell, just because the loss isn't too big yet, or, who knows, it might recover. I periodically review my entire portfolio. Any stock that no longer has a reason to be held, I sell, whether it's a small loss or a small gain. I need my portfolio to be flexible, not a graveyard for dead expectations. Another part of defense: don't overly trust the market. I don't assume the market is always right. I also don't assume it's always wrong. I just believe the market reacts. And that reaction can be reasonable or insane. I learn not to argue with it. If the market hates a stock, no matter how good I think it is, I don't hold it. If the market loves a stock, I don't rush in. I just observe the cash flow and decide whether to participate, never resisting the trend. Defense, ultimately, is about mindset. You must accept that there will be times when you're on the sidelines while others are making money. You must accept that you won't always be right. And most importantly, you must believe that capital preservation is more important than winning quickly. People like to brag about big wins. I prefer to talk about the times I exited a storm early. Because none of those big winners tell you about the times their accounts were wiped out. And that's the dark side of the market, where you only see the tip of the iceberg. The submerged part is the times of error, the pain, the lessons that only those who have been through it truly understand. I've lived through such times, and I will continue to tell you in the final part of Chapter 2, where I conclude this chapter with my deepest reflections on the limits of knowledge, the role of instinct, and why sometimes you should put your trust in silence. When you've been in the market long enough, you'll start to hear strange voices echoing in your head. Not the market's voice, not the news's voice, but your own. At that point, you no longer analyze in terms of should I buy or should I sell, but you ask yourself, am I acting based on reason or just trying to prove myself right? I once held a stock for 3 months. It neither rose nor fell, it just quietly moved sideways like a shallow lake. I began to doubt not the stock, but myself. I re-examined my reasons for buying it. I reread reports, rechecked charts, everything still looked fine, but something wasn't the same. The feeling when I entered the trade was certainty, now it was hesitation. I sold. A week later, the price began to fall, not because of bad news, not because of fundamental factors, but simply because the market shifted direction. And I realized that sometimes intuition tells you something that data hasn't yet revealed. Don't confuse this with impulsive action. I'm not saying you should trade on a whim. I'm talking about a form of intuition honed through experience, through hundreds of observations, thousands of hours of watching the ticker. It doesn't come from fear, but from inner quietness, a gentle whisper, it's time to retreat. And I learned to listen. Newcomers often think the more they know, the better they'll invest. They pursue more knowledge, more tools, more systems. I used to be like that. I studied every price pattern, every wave theory, every technical indicator. Then one day, I found myself fumbling amidst a pile of formulas and forgetting what the market was saying. I realized that knowing little but being right is better than knowing much and being wrong. And sometimes the answer isn't in the chart, but in how you react. Therefore, I began to gradually peel away layers of complex knowledge. I returned to simple questions. How is this business making money? Who is buying this stock? What expectations are they buying on? Do I see risks that others are overlooking? And if so, I act. Action, for me, is no longer about when to buy or when to sell. It's about survival. Action to protect, action to retreat, action to restart. I'm not afraid to cut losses. I'm not afraid to admit I'm wrong. I'm only afraid of silently maintaining a mistake due to pride. The investor's ego, if unchecked, will become leverage for losses. And for that reason, I rarely boast about how much I win. Because I know the biggest wins often come after the most painful falls. And the truly skilled person is one who learns from both sides. I once won 100% in just a few weeks, but the subsequent 30% loss taught me more than all of that. It taught me that the market is not fair, not kind, and never apologizes. But if you are humble enough to listen, it will show you the way. That path isn't straight. It's winding, sometimes hidden, sometimes visible. And to walk it, you need more than skill. You need a mindset, not swept away by turbulence, not intoxicated by pump-and-dump schemes, not lulled to sleep by a string of victories. I spent almost a decade building that mindset, not through books, but through countless times withdrawing money from my account with trembling hands. Someone asked me, "Are you still afraid of the market?" I replied, "I'm afraid every day, but I don't let that fear dictate my behavior. I use it as a compass. If I find myself fearless, I know I'm being complacent. If I find myself overly anxious, perhaps I'm betting too big. Fear is part of the journey, and you only truly mature when you learn to live with it." And finally, I learned to be grateful. Grateful to the market for teaching me discipline. Grateful for the losses that brought me back to earth. Grateful for the times I stood aside and watched everything collapse without being involved. Because in this game, the winner isn't the one with the most money, but the one who remains clear-headed enough to play for the long run. There's one thing I took almost half my life to truly understand. Surviving in the financial market isn't due to intelligence, nor luck, but to the ability to know your own limits. That limit isn't on a chart. It's in your head, in your heart, in that vague feeling when you know you're going too far but still push on. I used to think I understood risk until that very risk flared up in the positions I thought were safest. I used to believe in calculations until I realized that the volatility of human emotion dominates the trading screen, not any financial model. And I used to think I controlled my emotions until I made too much profit, too quickly, and started to believe I was invincible. When you make easy profits, it's very easy to mistakenly believe that the market is on your side. But in reality, it's just watching to see if you fall into the trap of overconfidence. I fell, and that fall cost me almost everything I had accumulated, not because the stock was bad, but because I didn't cut my losses in time. I kept holding, thinking it would recover. I kept waiting because I didn't want to sell at the wrong time. And by the time I truly wanted to exit, it was too late. The difficulty isn't making a decision, but making the right decision at the right time. Most investors lose money not because they don't know what to do, but because they don't do it when it needs to be done. They procrastinate, they hesitate, they let hope obscure logic. I once witnessed a friend hold a plummeting stock for a whole year just because he didn't want to admit his mistake. When he finally sold, the price had returned to its starting point of 3 years prior, 3 years wasted just because of stubbornness. Therefore, I began to build a set of non-negotiable rules for myself. For example, if an investment loses 10%, I will sell, no reason, no reanalysis, no argument. As soon as it hits that threshold, I act. Because I know if I start asking, what if it recovers? I'm planting landmines under my own feet in investing. The pain threshold should not be determined by emotion. It must be set beforehand, when the mind is still clear. I also learn not to overreach. People often say diversify to reduce risk, and that's true, but only if you know what you're holding. If your portfolio has 15 stocks but you truly understand only 3, then the other 12 aren't protection, they're a danger. I once had a portfolio of 20 stocks that looked very balanced, but when the market dropped, I couldn't keep track and didn't know which ones to exit first. The result was I stood still, and standing still while the market is plummeting is the most dangerous action. I started simplifying, holding only what I truly understood. I don't invest in businesses whose models I can't explain in a minute. I don't hold stocks just because others are holding them. I don't buy because the price is cheap. I no longer seek the best stock. I seek the stock most suitable for my psychology, capital, and strategy at the current moment. That was also when I gained a deeper understanding of the concept of the investment life cycle. A strategy that might work for a 25-year-old becomes a meaningless risk when you are 55. I used to invest as if I had a whole lifetime ahead of me, making big bets, accepting total loss in hopes of a breakthrough. But then I realized that when you have accumulated enough to live comfortably, what you need isn't to double your assets, but to protect them from being wiped out. I met many people who got rich through investing and also saw many who were once rich grow poor just because they didn't know when to stop. They thought past success was proof for the future. They forgot that the market has no memory. It doesn't care who you are, how much you've won. It only cares how you're betting today, and if you make the wrong trade, it will crush you without mercy. So I learned to return to humility. No bragging about profits, no rationalizing losses, no trying to prove anything. I invest not to show off. I invest because that's how I survive, through observation, analysis, and action in silence. I don't need anyone's recognition. I just need the market not to kick me out. When it comes to bonds, most retail investors often assume it's a safe channel. Fixed income, clear maturity, and guarantees from seemingly reputable institutions. But I've witnessed countless times how those prestigious debt instruments became worthless paper, not because the company defaulted, but because the bondholders didn't understand their nature. I call that false safety, and it's the most dangerous thing in investing. It lulls you into sleep without knowing you're standing on the brink of a pit. Bonds, in essence, are promises of fixed interest, but they don't guarantee the ability to maintain the real value of the money you've put in. If inflation skyrockets, if currency depreciates, if market interest rates fluctuate, then that fixed income becomes shackles binding your capital while the market evaporates. I'm not against investing in bonds, but I only do so when I clearly understand that I'm buying peace of mind, not profit. And when there are unusual macroeconomic signs, I withdraw immediately without hesitation. I once heard someone boast that his portfolio was 60% corporate bonds and called it a safety cushion. I asked, if half of those bonds came from real estate companies facing liquidity crunch, would you still call it a cushion? He didn't answer. In investing, there are questions you want to avoid, but it's precisely those questions that save you. Then I talk about diversification, the bread and butter of every financial advisor. Some people present a list of dozens of stocks, funds, bonds, gold, and foreign currency to prove their comprehensive portfolio. I look at it and see only one thing: panic disguised as academic rigor. They don't know what they're doing, so they do everything. I don't diversify by quantity, I diversify by the nature of risk. If two investments react similarly when the market fluctuates, they aren't two, they are one. You're deceiving yourself with different names. I prefer to keep things simple. 3 to 5 investments are enough. Each one is closely monitored, deeply understood, and has a clear exit plan. No stock is left, long-term, without reevaluation. Investing isn't planting a tree and forgetting to water it. You need to check if the soil is eroding, if pests are crawling up, and if the tree is still alive. If not, pull it out. For a while, I was fascinated by international investments. Looking at the US, Japanese, European markets, I saw treasure troves there. But when I started transferring money out, I realized I was entering a game I didn't understand the rules of: language differences, legal regulations, monetary policies. Everything could become an unforeseen risk. And although many people got rich from it, I pulled out. Not because I was scared, but because I knew that high returns coupled with a large information blind spot was a gamble I didn't want to play. Instead, I learned to delve deeper into what I understood well: the domestic market. I don't need to know everything happening globally. I just need to clearly understand where I put my money. I view investing as an intimacy with an economic system, a management culture, a cash flow. If I don't understand it like an insider, I won't participate. I also experienced a form of controlled speculation. I don't deny speculation in essence. Most transactions on the exchange are speculation to some extent. The difference lies in whether you speculate with a strategy or are just a gambler in a suit. I chose stocks with strong fluctuations, but only with a small allocation in my portfolio. I clearly define these as quick battles with no room for prolonged hope. If I profited, I exited early. If I lost, I cut mercilessly. I didn't attach emotions to such stocks. They were tools, not assets to be proud of. And when the market is euphoric, I learn to step back. Standing amidst the shouts to "buy now," I ask myself, if everyone is buying, who will sell to me when I want to exit? I once bought a hot stock just because every forum was talking about it. I entered right at the peak, and when the price started to drop, no one discussed it anymore. The forums were silent, the brokers were silent, it was just me and the negative numbers in my account. That's when I understood: the crowd only goes with you to the elevator door. After that, you go in alone. I once thought that valuing a company was a mathematical problem, a formula. You take profits divided by shares plus expected growth minus debt multiplied by the industry coefficient to get a result. But then I realized that if investing were that easy, every engineer good with Excel would be a millionaire. The reality is that valuation is like taking the pulse of a living organism. It requires you to not only know the numbers, but also to understand what doesn't appear in the reports. I once researched a company with perfect financial metrics: EPS, ROE, positive cash flow, but something felt off. Management was continuously selling shares. The media was suddenly overly positive, and the company announced expansion into many unrelated fields. I didn't buy. 6 months later, an accounting scandal erupted. The stock price dropped 70% in a week. At that moment, I knew that intuition, born from observing thousands of businesses, is something that shouldn't be overlooked. Valuation isn't just about the present, it's the market's expectation for the future. And expectation is the most elusive thing in investing. A business can be good, but if investors' expectations have far exceeded reality, the stock price will still fall. Conversely, an ordinary company, if expectations are low enough, can create a wave of price increases with just one positive signal. I learned not to value based on isolated data points, but on the psychological context of the market at that moment. I also learned a lot while traveling, not leisurely travel, but trips to observe local economies. I once visited a small town in Japan where there was a factory producing components for the electric car industry. Everyone said the parent company in Tokyo was a growth star, but when I arrived, I saw the factory operating at half capacity, many production lines idle, and workers complaining about reduced shifts. I didn't invest in that stock. A few months later, sales plunged, causing the stock to crash. These things you don't see on a balance sheet. Observing the real world is an underrated skill in the digital age. Everyone looks at data and forgets that data is what happens after reality has already unfolded. But reality, like the number of cars delivered, new stores opened, or warehouse conditions, isn't in an Excel spreadsheet. I once invested in a logistics company after personally visiting their warehouses, talking to drivers, and checking actual delivery times. The financial report that year wasn't stellar, but 6 months later, when the numbers improved, the stock had already risen 50%. That's why I always say investing is a profession that requires going out, not just sitting still. I also gradually developed a softer view of the concept of speculation. I used to despise speculation as a form of gambling. But then I saw that if you enter the market with short-term profit goals, have an exit plan, and manage risk strictly, then it's still a conscious way of investing. I only oppose aimless speculation, jumping into hot stocks out of FOMO, making big bets without knowing why, holding onto losses because, who knows, it might recover. Speculation becomes dangerous not because it's fast, but because the player doesn't know what they're doing. I clearly categorize long-term investing, cyclical investing, and short-term speculation. Each strategy has its own rules, its own allocation, and its own limits. Do not mix them. If I'm long-term investing, I don't look at the ticker every hour. If I'm speculating, I don't hold overnight. And if I'm not sure what game I'm playing, I withdraw my money until I can redefine my strategy. Towards the end of my journey, I started to ponder something few people mention: the relationship between investing and aging. When I was young, I wasn't afraid of losing money. I was only afraid of missing opportunities. But the older I got, the more I realized that the most valuable thing I had wasn't profit, but time, peace of mind, and the ability to sleep soundly. I no longer invest to double my assets, but to ensure I don't have to worry about money, so I can focus on more important things. Life. There was a period when everything seemed peaceful: the economy recovering, the market growing steadily, central banks cutting interest rates and promising to maintain loose policies. People started talking about a new normal, as if the storms had passed and we were entering an era without volatility. I listened to those words with a quiet smile, because in investing, nothing is normal, and certainly nothing stays new forever. Financial history is like an old song remixed with modern rhythms. Inflation, bubbles, defaults, liquidity crises. All have happened before, just in different versions. When people started believing inflation was dead for good, it returned with greater ferocity. I've witnessed that many times. I saw inflation erode the value of bonds, wipe out accumulated profits, and strip away the confidence of even the most conservative investors. During inflation, cash is no longer king, but it's not trash either, as many mistakenly believe. It's the most flexible tool you can hold. It helps you stay out when assets are inflated and jump in when everything goes into freefall. I don't hold all my assets in cash, but I always reserve a sufficiently large portion to be able to act when others are panicking. I was in the market when interest rates rose uncontrollably, bonds plummeted, stocks crashed, real estate froze. All valuation models based on low interest rates collapsed, and people began to realize they had built their entire financial strategy on a virtual foundation, assuming interest rates would always be low. I never believed that because I understood the nature of currency. It's a double-edged sword, and central banks are not eternal benefactors. That's when I returned to the simplest principle. Invest in what you understand, what you can control, and what you are willing to hold through market reversals. I don't believe in invincible assets. No stock is good forever, no real estate always appreciates. There is no absolute safe haven. There are only investors who understand where they are in the cycle and know when to retreat. Sometimes doing nothing at all is the right action. You don't need to be in the market all the time. You don't need to trade every week. I once stayed out of the market for 5 straight months, just observing, taking notes, and refreshing my thinking system. In those 5 months, my friends laughed, saying I had lost my fire. But when they were wiped out in the 6th month's correction, I started accumulating assets with a calm, undamaged mindset. Because I didn't have to recover, I just needed to continue. Resting isn't giving up, it's preparing. I'm not afraid of missing a wave. I'm only afraid of chasing a wave whose origin I don't understand. I've seen many people hold onto profits until they were exhausted because they didn't know when to stop. I've seen people hold a stock that tripled and then watched it drop by half without selling. Not because they were greedy, but because they had no plan. They thought they were long-term investors. In reality, they were just paralyzed by victory. Big wins are also a trap. They make you believe you're skilled. They make you think the market will always be this way. And then you increase your position, use leverage, withdraw all your cash to optimize capital until the market changes and you're too late to pull out. I learned to take profits as coldly as I cut losses. Never wait for the peak. As long as the expected level is reached, I exit because I believe a realized profit is always safer than a paper profit. Someone asked me, "Do you regret selling too early?" I said no. Because I don't play the game of guessing the top. I play the game of risk management. I don't need to sell at the exact peak. I just need to prevent the peak from becoming the bottom. Investing isn't about being perfect. It's a game of consistency. If you win 7 out of 10 times and cut losses at the right time in the other 3, you're better than 90% of people in the market. It took me years to accept a simple truth. Luck plays a bigger role than we think, but smaller than we tend to blame. Newcomers often attribute all success to skill and failure to bad luck. Experienced people, conversely, are wary of both. I don't deny that sometimes I got lucky, buying the right stock just before a big wave or selling just before bad news. But I don't let those moments create the illusion that I'm invincible. Instead, I see luck as a reward for preparation. If I hadn't observed, hadn't taken notes, hadn't honed my analytical skills, then even if opportunity came, I wouldn't recognize it. You can't control luck, but you can control the state you're in when luck arrives. If you are always ready, you won't need to pray. I also no longer put too much faith in experts. For years, I attended dozens of seminars, listening to the slick rhetoric of those who called themselves investment masters. They had theories, they had charts, they had carefully selected past results to prove their talent. But they had no answers when things went wrong. They had no plan for the worst-case scenario, and they very rarely said, "I was wrong." In the market, everyone is right until they are wrong. I was once advised by someone with an impressive track record until he took too big a hit on a real estate deal and had to sell off all his assets. I once followed a stock wizard praised by the press until he was investigated for price manipulation. From then on, I stopped idolizing anyone. I listen, I learn, but I always retain the final decision-making power, because ultimately, no one is responsible for your account but yourself. The truth is, investing doesn't require you to be a genius. It just needs you to know who you are, where you are, and what you're doing. If you can do those 3 things, you're ahead of most people in the market. I don't invest to be the best. I invest to not be eliminated from the game. And to do that, I need many things: knowledge, experience, patience, discipline, and the ability to forgive myself when I'm wrong. Because you will be wrong many, many times. I was wrong when I trusted a seemingly clean management team who turned out to be report manipulators. I was wrong when I thought a declining industry would suddenly revive strongly. I was wrong when I thought I understood everything, and I was also wrong when I thought I couldn't be wrong anymore. But through each mistake, I learned a deeper layer of understanding about myself, about the blind spots in my perception, about how I react when the market goes against me, about how I treat my own money when it no longer grows steadily as before. And I realized that investing is more an internal job than an analytical one. Some people have excellent analytical skills, but panic when the market crashes. Some people read macroeconomics like prophets, but don't dare to make decisions. Some people are so good at technical analysis, they can draw waves in their sleep, but don't dare to cut losses at the right time due to regret. I learned to be just enough, understand the market enough to act, understand myself enough not to destroy everything when stress hits. And above all, I learned to let go. Let go of unrealistic expectations. Let go of positions that are no longer logical. Let go of old judgments when new data appears. Let go of what I want the market to be so I can see what it is. I no longer force the market to follow me. I follow the market, but not blindly. I act conditionally. I place orders with stop-loss limits. I always have a plan B if plan A fails. Perhaps the most valuable thing I learned throughout this journey is humility before life's randomness. No one can be certain. No one can read everything. The market is a wild beast. Sometimes you ride it, sometimes you're thrown off. But if you understand its rhythm, if you know when to dismount, you will survive. And sometimes, surviving is a greater victory than any reward. When you've lived with the market long enough, you'll realize profit isn't the most precious thing. The most precious thing is the experience of survival, the lessons etched into your very being, the moments when you know for sure that if you maintain your sanity, next time you'll do better. Investing doesn't make you smarter, but if you listen enough, it will make you deeper. I didn't write this book to teach you how to get rich. I don't believe there's any formula that will make you rich if you don't understand yourself and aren't willing to learn from the market. I wrote it because I want to recount a life of survival, a journey full of wrong guesses, delayed decisions, painful stop losses, and even unbelievable wins. But all of it is true, unborrowed, unembellished. Perhaps the biggest thing I want to pass on is that investing is an inner journey, not for the lazy thinker, and certainly not for the complacent. The market doesn't demand that you are always right. It only requires that you don't let your mistakes kill you, that's all. And to do that, you have to learn to think differently, to doubt the obvious, to question what the crowd is applauding. I once sat down with many young investors. They brought enthusiasm, new tools, beautiful charts, and the belief that they would beat the market. I didn't pour cold water on them. I just asked one question: if everything goes against expectations, what will you do? Most had no answer, or their answers were assumptions like, I'll buy more, I'll rotate capital, I have a stop loss. But these were all assumptions until the market actually crashed. And when the market crashes, no one can keep a cool head if they haven't genuinely experienced it. You'll see strange things in a sell-off. Your sell orders might not get filled. Stocks you thought had high liquidity suddenly dry up. Brokers' phones are busy, forums are silent. Investment mentors disappear, and you're alone in front of a red-hot trading screen, having to make a decision. That's when you understand this game is real, and you're using your own real money. That's why I always advise young investors to start with skepticism. Don't trust anyone completely, not even me, not even this book. Don't trust any formula that guarantees a win. Don't trust selective statistics. Verify everything with observation, experience, and your own perspective. And learn to say, I was wrong, as early as possible. Because sometimes, that's the most valuable statement of your life. What I've written isn't for you to apply verbatim, but for you to reflect upon. You might disagree with me, that's fine. But ask yourself, if you disagree, what are you basing it on? Emotion, belief, or data? If you don't have an answer, you're merely opposing the experience of those who came before you with baseless arrogance, and the market will deal with that arrogance mercilessly. Now I spend most of my time observing rather than acting. I no longer need to prove anything to anyone. I have enough assets to live, but the lessons I've learned, I want to leave behind. I don't believe I'm the best, but I know I've survived long enough to see how many better people than me were swept away because they didn't know when to stop. I survived because I accepted my limits. I am disciplined, and I never stop learning. And before I close this book, I want to leave one question, not for you, but for myself and for anyone walking this investment path. Am I acting according to the truth of the market, or just according to the beliefs I've grown accustomed to? If every day I ask myself that question honestly, I know I'm still heading in the right direction. I don't need to be right forever. I just need to not lose so much that I can't continue. Thank you for listening to my story this far. I hope even a small part of these stories can help you walk slower, more surely, and more soberly amidst the frenzy people call the free market. And if you survive long enough, you will find that what you retain isn't money, but an understanding of life. And that is something no one can take from you. Thank you. The silent reader, the steadfast listener, the unassuming companion who chose to walk with me and this book until the very end. You might have started this journey with the expectation of being equipped with a few more investment tactics, but if you are still here, I believe you have gained more than that. A different perspective on the market, on money, and on yourself when facing difficult decisions. We have just gone through a text written almost a century ago, yet today it retains its ability to touch upon the most fundamental questions. How not to lose oneself in a merciless game. And is investing truly a technique, or a challenging process of self-cultivation? I don't expect you to agree with every argument presented. But if, during your listening, you paused for a few seconds to ask yourself whether you are investing or just comforting yourself, then this journey has achieved the most important thing. sparking reflective thinking. I would appreciate it if you took the time to leave a comment, no need for it to be long or formal. A few honest lines about your feelings, about what you found true or what needs to be re-examined, would be a necessary extension to the dialogue this book initiates. And if you have a book that you would like to hear told in a different way, without repeating advertisements, without being complacent, without sugarcoating, please send me your suggestion. No book is too old if it still helps a person see reality more clearly. No book is too difficult if we approach it with the patience of those who are not afraid to go slowly. Finally, if there is one thing I want to leave behind, it is this: knowledge, if only to be known, will gradually die. Knowledge, if lived with, has the chance to become a part of us. See you in the next book.